to share an overview of our trading strategy. And really, it's quite simple, and we believe it to provide above market yields with a minimum amount of risk. The very first step is to identify a number of high yielding blue chip stocks you'd like to own. And these are, for the most part, stocks that you have heard of. You've probably got them in the pantry at the house. We're talking about stocks like Bristol Myers, Johnson & Johnson, AT&T, just big, reliable companies that pay between a 3 and 4% dividend. Once you've identified a number of those stocks, the next thing you do is you define a price that you're willing to own the stock at based on their dividend history. For example, if you want a stock that's paying 5.5%, AT&T does that. So you can go out there right now, buy AT&T at $30 and get a 5% dividend. So once you've identified the price point that you're willing to buy the stock, get paid to buy it. And the way you get paid to buy it is by selling cash covered puts. Basically, you're getting paid a premium to put a buy order in at a price that you're comfortable with. And like all options, you're going to have an expiration date. So the agreement for this option is for a set period of time. You're going to have a strike price where you name the price that you're willing to acquire the stock at if you're selling a put. And then lastly, there's a premium, and that is what they will pay you for you to have the obligation to buy that stock at that price for that period of time. And that money is in the bank. If by your expiration date the stock price is higher than your strike price, then your agreement for the option expires. You keep the money, and you're welcome to repeat and do the same process all over again. If, however, the stock price has fallen below your strike price, then you're going to acquire it. It's going to be assigned to you, and you will hold that stock, collecting quarterly dividends as long as you own it. But it is not your intent to own that stock and limit yourself to that 4 or 5% dividend return. You want to make more than that. So if the stock is put to you, you would immediately sell stock covered calls, which basically means you're getting paid a premium to put a sell order in at a set price that you were comfortable with. For example, if you had a $30 cash covered put and the stock was put to you at $30, you could turn right around and sell either a $30 or a $31 call, saying that you want to sell the stock at $30 or $31, and you'll get paid to put that in. And when the stock is disposed of, you go right back to the beginning and you open another cash covered put. And you keep going through this exact same cycle over and over. So, having said all that, the question that Mike and I are constantly asked is, well, if it's that easy, why doesn't everyone do it? And, great question. There's a number of reasons. One of them is the fear of the unknown. People just have a tendency not to jump into something they don't know. Second is a fear of losing everything. Oh my God, I'm going to make a mistake. I'm going to lose every penny I've ever earned. Some people even say, well, I don't have a brokerage account. That's probably the easiest one to fix. Many people are just too lazy to do it. Hate to be that blunt, but you have to invest the time. It's just that simple. Some people don't have the spare capital to work with, and that's understandable. You don't need a lot. You can start small and make very small option positions. Also, you can do this in an IRA, but you can't do it in a 401k. So again, that limits some people. One of the big ones for more sophisticated investors is it's not exciting. There's no home runs. There's no bragging. You're not going to be able to go to a cocktail party and say, hey, I bought this for 100 and sold it for 1,000, a 10-bagger. It's boring investing, and it's a strategy that pays a reasonable return. Basic blocking and tackling.